Welcome to enrichminds.com and to this session on the first valuation model we shall discuss, called DCF or Discounted Cash Flow Model. We shall learn the most commonly used valuation technique called DCF or Discounted Cash Flow Model. Discounted cash flow, as the name suggests, is the sum of all future cash flows discounted to present value. In other words, it is the sum total of the present values of all future cash flows. That number gives us the enterprise value of a company. When we subtract the value of all its liabilities, we are left with the net worth or the equity value of the company. If we divide that equity value by the number of shares outstanding, we will get our estimate of the per share value. In the first section today, we shall learn about DCF. In the second section, we shall discuss one of the main inputs that drive the DCF model, called WACC, or the Weighted Average Cost of Capital. First, let's watch a short video on DCF courtesy of Investopedia.
Discounted cash flow, or DCF, is a valuation method used to estimate the attractiveness of an investment opportunity. DCF analysis uses future free cash flow projections and discounts them to arrive at its enterprise value, which is then used to evaluate the potential for investment. If the value arrived at through DCF analysis is higher than the current cost of the investment, the opportunity may be a good one. Jane is interested in buying shares of Miranda Cruises, a solid company trading at $250 a share, a debt of $50 million, and has a steady flow of revenue coming in every year. Jane crunches some numbers and calculates Miranda Cruises' DCF, starting with forecasting future cash flows for the next 5 years. Jane then looks for the company's weighted average cost of capital, or WACC, which reflects the risk of the cash flows and uses it as the discount rate for the following DCF formula, where R is equal to the discount rate and CF is Miranda Cruises' future cash flows in multiple periods. Jane uses the formula to calculate enterprise value. She then subtracts the company's net debt from its enterprise value to get its fair value of $215.3 million. Dividing $215.3 million by the company's 1 million outstanding shares, Jane finds that one share of Miranda Cruises is worth $215.30. Since its DCF is below the share price, Jane decides to pass on the investment because the stock looks overvalued.
Discounted cash flow, or DCF, helps determine the value of an investment based on its future cash flows. The present value of expected future cash flows is arrived at by using a discount rate to calculate the DCF. If the DCF is above the current cost of the investment, the opportunity could result in positive returns. Companies typically use the weighted average cost of capital, or WACC, for the discount rate because it takes into consideration the rate of return expected by shareholders. The DCF has limitations, primarily in that it relies on estimations of future cash flows, which could prove inaccurate. We shall now walk you through a DCF model step by step. The first step in the DCF model process is to build a forecast of the 3 financial statements based on assumptions about how the business will perform in the future. On average, this forecast typically goes out about 5 years. Of course, there are exceptions, and it may be longer or shorter than this. This gets more complicated than this. The forecast has to build up to unlevered free cash flow, or free cash flow to the firm, or FCFF. It would take a lot of time to discuss how to calculate unlevered free cash flow, but the quick answer is to take EBIT less capital expenditures plus depreciation and amortization less any increases in non-cash working capital. So now that you know how to calculate the free cash flows, we have to recognize that we only have 5 or 6 such projected values. The next step is to estimate the terminal value of the company. Since the company will not just stop operating after year 5, we have to account for all the cash flows from year 6 onwards. That value is called the terminal value. As in, what would be the value of the company if it were to be sold in year 6? There are 2 ways to approach the terminal value calculation. One is the perpetual growth method, which assumes that the free cash flows continue to grow at the same moderate growth rate. We shall ignore that method. The other method is the exit multiple method used by industry practitioners. We multiply the free cash flow from year 5 with a certain market multiple and assume that to be the terminal value in year 6. This multiple is taken from looking at the valuation of comparable companies in the market as a multiple of EBITDA or EBIT. For our purposes, say we use a multiple of 10. We should call it TV, or terminal value of the company. So now we have projected free cash flows as shown, including the terminal value. Let us also remind ourselves of the present value and future value lesson we learned earlier and the way to discount the cash flows. In this case, the year 1 number has to be discounted for 1 year. The year 2 free cash flow has to be discounted back for 2 years, and so on. In effect, we shall get 6 present values for the 6 free cash flow numbers from the 5 years. This step is also called the discounting step. All future cash flows are discounted to the present time as shown. We then add all the present values to get the net present value, or NPV, of the company. That is the total enterprise value of the company. The final step is to add all the present value numbers and arrive at the enterprise value. Then it gets simpler. Enterprise value minus total debt plus cash on the balance sheet equals equity value, or the net worth of the company. Equity value divided by the total number of shares is equal to your estimated per share price. If this is higher than where the company's shares currently trade at, we should buy. If this is lower than where the company's shares currently trade at, we should wait and not buy. The biggest question we just skipped is what discount rate, or R, to use when discounting all future cash flows. The answer is we should use a discount rate called the WACC, or the weighted average cost of capital. We shall discuss WACC later, but first let's look at some screen grabs of an actual DCF model at work, so you get a sense of what the Excel file should look like, and we shall also provide you with a free Excel model so you can practice on your own. This screen grab shows the projected P&L statement for 6 years. The years 2012 through 2016 are the actual historical results, and then the years 2017 through 2022 are the 6 years of projected financials. This screen grab shows you the calculation of the free cash flows and the terminal value, and then the calculation of the enterprise value and equity value, and also the value per share for the company. Let's now remind ourselves on how to discount the stream of future cash flows. For the first year, we shall divide by, in parentheses, 1 plus R, close parentheses, where R is the discount rate or the weighted average cost of capital. For the second year, we shall divide by, in parentheses, 1 plus R, close parentheses, all raised to the power 2, and so on, such that for the nth year, we shall divide by, in parentheses, 1 plus R, close parentheses, and the entire amount raised to the power n. Then we add all the present values to get the final DCF value. In the second section now, we shall discuss and learn about WACC, the weighted average cost of capital. A firm's weighted average cost of capital, or WACC, represents its blended cost of capital across all sources, including common shares, preferred shares, and debt. The cost of each type of capital is weighted by its percentage of the total capital, and they are added together. Let's watch a video first and then look at the formula.
Weighted average cost of capital, WACC, measures a company's cost to borrow money given the proportional amounts of each type of debt and equity a company has taken on. A company's debt and equity, or its capital structure, might include common stock, preferred stock, and bonds. WACC is used internally by a company's management as part of determining whether it would be profitable for the company to finance a new project. It is also used by investors as one way to value the company's shares and decide whether to invest. The higher the WACC, the less likely it is the company is creating value because it has to overcome more expensive borrowing costs in order to make a profit. Mary is considering an investment in John's Gyms. She determines that the company is producing a 10% return and calculates that the company's WACC is 8%. By subtracting the WACC from the return, she sees that for every dollar John's Gym spends, it creates 2 cents of value. If John's Gyms had a WACC of 15%, it would be destroying 5 cents of value for every dollar it invested. If its WACC were 10%, the company would be neither creating nor destroying value, but remaining stagnant. Mary thinks she might pass on this investment because while the company is creating value, it's not creating as much as she'd like to see. However, WACC is just one of several tools she uses to evaluate her potential investment. The formula to calculate WACC is WACC equals E over V times RE plus D over V times RD times 1 minus TC, where RE equals cost of equity, RD equals cost of debt, E, market value of the firm's equity, D, market value of the firm's debt, V equals E plus D. E over V equals percentage of financing that is equity, D over V equals percentage of financing that is debt, TC equals corporate tax rate. Because the WACC formula is so complicated, many investors don't look at this measure, and two investors that perform the calculation for the same company might come up with different results. To simplify the work, however, investors can use an online WACC calculator.
This is a pictorial description of how WACC is calculated. It is used in financial modeling as the discount rate to calculate the net present value of a business. We have to separately calculate the cost of equity and the cost of debt. The cost of equity is calculated by taking the equity risk premium and multiplying it by the beta of the company and adding the risk-free rate to it. The risk-free rate is the yield on the 1-year U.S. Treasury note at the time. The beta is a number we learned about when we studied stock charts. It is a number that shows how risky a company is compared to the overall market. If beta equals 1, it is as risky as the overall market. If beta is greater than 1, then the company is more risky than the market, and beta less than 1 means the company is less risky than the overall market. Beta is a measure of how risky the investment is. We can find the beta from any stock chart or Google it too. For the cost of debt, if the company has any debt, we can find the yield on its bonds from the income statement or even the balance sheet. we multiply that by 1 minus the tax rate to get the tax shield, as interest payments are tax deductible. We simply add the cost of equity and the cost of debt in proportion to obtain the weighted average cost of capital, or WACC. So we plug in some numbers from publicly available sources and we calculate WACC. Do not worry about it too much. You could literally simply Google WACC for Microsoft, and today it would show it to be 8.4%. Or for Google, it is 8.3%. Just use that as your WACC number. Google has made everything easier, including calculating WACC. Simply search for the WACC of any company, and it is immediately available to you. Calculating the DCF involves 3 basic steps. First, forecast the expected cash flows from the investment. Second, you select a discount rate, typically based on the cost of financing the investment or the opportunity cost presented by alternative investments. Third, the final step is to discount the forecasted cash flows back to the present day using a financial calculator, a spreadsheet, or a manual calculation. Also, WACC is key to the DCF calculation. So, our takeaways from today's session are: first, DCF is an easy valuation technique. And second, but WACC drives the outcome. Thank you for your time, and until next time then, stay enriched and strong.